I'm Tess Downing, founder of Complete View Financial, and welcome to this month's video blog. Today I want to talk about Roth IRAs, the benefits around Roths, and a unique strategy called the Mega Backdoor Roth. So first, let's have a quick background on Roth IRAs. The benefits of a Roth IRA are many, but just some listed here include tax-free growth on investments, withdrawals are tax-free in retirement. You can continue your contributions after the age of 70 and a half, and there are no required minimum distributions at the age of 72. Roth IRA contribution limits are $6,000 in 2021 if you're under age 50, $7,000 if you're age 50 or older. But here's where some of the problem comes in. Modified adjusted gross income limits for 2021 are $140,000 for single and $208,000 for married filing joint, which means many high earners are no longer eligible to contribute to a Roth IRA. So what are some strategies that we can employ to get around some of this? There are two that come to mind: the Backdoor Roth IRA contribution and a new one, the Mega Backdoor Roth. So first, let's look at the Backdoor Roth IRA. Many of you have probably heard about this, where you simply make non-deductible contributions into your traditional IRA, and on an annual basis, you move those contributions to your Roth IRA, paying tax on any of the earnings. Something to make note of here, though, would be the pro rata rule. If you have any pre-existing 401ks that you had rolled into IRAs that have pre-tax dollars, you could incur major tax consequences. So always good to really understand the pro rata rule and to make sure that you're eligible for this Backdoor Roth. Now on to Mega Backdoor Roth IRA contributions. A Mega Backdoor Roth involves making after-tax contributions over and above the annual 401k contribution limit to your 401k plan. For high-earning individuals who can afford to do this, the Mega Backdoor Roth can be a way to funnel significant amounts to a Roth IRA account. In order for a Mega Backdoor Roth to work, your employer must allow after-tax non-Roth contributions to be made to the plan, and these contributions are made to a separate bucket over and above your normal contributions to the plan. So here's some considerations to think about when you might consider if you're eligible or your plan has this option. Number one, does your 401k allow non-Roth after-tax contributions? Right now, about 45% of all 401k plans have this option. Does your company's 401k allow in-service withdrawals? Even if they do not allow in-service withdrawals, this might be an option, but ideally you would like the option of in-service withdrawals on an annual basis. Are you currently maxing out your 401k plan? Does your employer match your 401k contributions? The overall limit on defined contributions in 2021 is $58,000. If you're over the age of 50, to include catch-up contributions, your max is $64,500. So if you are an ideal candidate and can answer yes to all of the above questions, you would contribute the maximum after-tax contribution amount, complete an in-service withdrawal on an annual basis, and the withdrawal should be classified as a rollover to a Roth IRA. As you can see, there are a lot of factors to determine if you're eligible and if it makes sense from a tax perspective. Feel free to reach out to me or your financial advisor to talk through some of the details here and if this might be a great way to get money from a pre-tax environment moved into a Roth IRA to take advantage of this. Now, lastly, I would like to conclude with a quick reminder about the stock market, given all that has been happening in the news, from GameStop to Bitcoin to Tesla. Overall, investing should not feel like a trip to Vegas. We are in this for the long haul. We want well-diversified, risk-adjusted portfolios that meet your goals and retirement needs. So I get a lot of questions from investors about what they can expect on average from investment returns. So this is always a tricky question, as there are so many factors to account for, such as the risk tolerance, time horizon, the types of accounts they own, legacy positions, contribution amounts, and the list can go on. But I thought this chart did a nice job of outlining some of those factors. The U.S. stock market since 1926 has provided investors with an average annual return of about 10%. But it's important to remember that returns in any given year may be sky high, extremely poor, or on average somewhere in between. So annual returns came within only 2 percentage points of the market's long-term average of 10 in just 6 of the past 94 years. Yearly returns have ranged as high as 54% and as low as 43%. Since 1926, the annual returns have been positive 69 times and negative 25 times. So understanding the range of potential outcomes can help you stick with a plan and ride out the inevitable ups and downs, and that average of 10% doesn't actually happen all that often. Thanks for listening in to this month's video blog.